Hey, this is Nancy Conrad, and we recently had a meeting with our Phoenix Meetup group, and I share with them tricks of the trade for the note business and how to turn a 7% yield into a 75% yield. So getting rich slowly, we like to utilize the time value of money, which is great when you have something that's paying you interest over a long period of time, because then you can watch your money grow. And what we're going to do is talk about how to make your money work harder and make more of it. So I wanted to start by just explaining that the number one myth with notes is if you have a $100,000 note, this is not the same as $100,000 cash. So if you're going to go buy a note from Jane and Bob Smith and they've financed a house and it's $100,000 that the borrower owes, it's still not $100,000 if you go buy it. Well, why is that? Well, okay, so let's look at that. That $100,000 note might pay $388.45. That's 6% for 15 years. Jane and Bob have this promise to pay, which is fine. But that promise to pay is not the same as today's value. So I'm going to use this lottery example. You've heard about the cash out or cash option that you can take if you win the lottery. This was a recent lottery amount, $340 million, that the Mega Millions people would pay you for your jackpot if you were lucky enough to buy it. That's $204 million if you take the cash. So if you run that on the calculator, they're basically giving you $340 million, which is the $204 million over 30 years at 3.75%. which kind of sucks. So if you ever do win the lottery, take the cash, right? I mean, that's the same as if you're buying a note from somebody. Is it worth more to take the cash now or to take the payments over time? Well, it depends. And that's kind of what we're going to dig into right now. So if you're going to talk to a note seller, your question to them would be, would you rather have a lump sum now or a promise to pay over time? Well, from my perspective, a promise to pay over time is fine, but I always take into account these particular costs because they might affect the yield. So if on paper I'm getting 15%, if I've got to go through a problem and the borrower flakes out on me, I can take that property back, but I have to be prepared to pay these things: holding costs, repairs, closing costs, bankruptcy if that borrower goes through a bankruptcy, eviction costs, costs of foreclosure, the normal wear and tear in the house, the municipal fees, taxes, HOAs, insurance. Now, I don't want to scare anybody because those are things that you do take into account. You got to figure out what those costs will be and what the likelihood that you might have to go through them. If the property is the right value, you'll jump in. But bottom line is that you don't get your yield until you're paid off. It's a promise. So why are notes discounted? The discount is not because of the time value of the money, but that risk that I talked about right here, because you may have those costs. And it's fair for you if you go to Jane and Bob Smith to go buy that note to say, hey, I may have these costs, so therefore I can't give you $100,000 for that note. Fair enough. But as I go through this, I'm going to show you how you can still work with Jane and Bob and make them happy. So let's start with something very, very basic. Let's say Jane and Bob have a note on we'll say it's a mobile home. It's $10,000. They're getting paid on a note of $10,000 at 7%. It's payable monthly for 10 years at $116.11. Well, it's not bad. 7%. It's not horrible. So this is what it looks like on the 10BII calculator. If you do not have this calculator, I suggest you go get it. It's like $6. Something like that. You can have it on your phone or your laptop or your iPad. And this is kind of how that works. 120 payments, that's 10 years. You input that and you click in. 7%, you click 7, then you hit this number and it inputs it in the interest rate per year. This is the present value, the PV right here. And we put it at negative $10,000 because these are positive payments. So there's one negative side and one positive side. You could switch these if you wanted to. And this FV is future value, which is not something you need to have in this case. So this is just a basic amortization over 10 years. So let's say you offer to buy the note from Jane and Bob for $6,000 because, you know, as we went over the potential downsides of having the borrower fail, you might have to go kick the borrower out and take the place back. And this is what that would look like. You put in $6,000 for the present value. You have 120 payments that the borrower is going to pay. Borrower's paying 116. And then you solve for interest rate per year, and it comes out with this very nice whopping 20.04% on the money. Well, that would make $6,000 a spectacular deal for you, and a pretty small amount of money to be able to jump into a note investment. So let's say you go to the borrower, and now this is after you own the loan, by the way, because you don't want to be talking to borrowers until you actually own the loan, because that's a big no-no. So let's say you go to the borrower and you say to him, I'm going to cut your interest rate in half if you agree to double your payments. Okay, so what does that look like? The borrower still owes you $10,000, but you bought it for $6,000, right? So here's what your numbers look like. The present value they owe is $10,000. You say if you double your payment, it was $116.11. Now it's $232.22. You've cut down their interest rate to 3.5%, which is a screaming deal for them. And even better for them, now the number of payments has gone to 46 months and change. Well, that's really good. I mean, that's less than half of the number of payments. So they will own that mobile home that much faster. What does that look like for you? Well, this is pretty cool. At 46 months, 232 payments, and you bought it for $6,000, your interest rate is 33.28% on your $6,000. Well, that's awesome. That rocks. You could do these all day long, times 10, and get an awesome return on your money. So that's one of the ways that you can increase the value of your notes, just by working with the borrower. Well, let's make that even better. Let's say you offer to go to your family member or another investor or a friend, and you say, would you like to get 12% on your money? Well, heck yeah, absolutely, yeah. So what they would do is they would they'd be receiving their payments over 46 months. It would be 12 payments a year. You give them half. So that $232.22, you split it. And for that, they will give you $4,270. Awesome. That gives them 12% on that money. Nice, tidy little investments, a small amount, and not too scary, and they get a great return. Let's take a look at what you are getting. When you subtract this amount of money that you got from your investor or your family member or your friend, this is what you have left in the deal. You have $1,789.21 because you split the payment. You're still keeping those $116 payments. You basically invested less than $2,000 to get these payments over a period of time at a whopping 75%. Well, that rocks. And all you did was give somebody a good deal right here, the 12%, and you gave the borrower a good deal by giving them 3.5%. Everybody is a winner. Now, this is a small number, and we use this because it's just something that can illustrate to you the sort of things that you can do with a note if you don't mind talking to people and figuring out a better deal. Then you're going to turn into a rock star. And now for me, I'm in a self-directed IRA. If I did that sort of thing with all of my notes, I could really increase the speed at which my IRA grows. This is absolutely the power of notes and what it can do. So let's say you started with $100,000 and you did that $10,000 investment or I actually had 6,000 in there, but I'm just using the 10,000. And you got 75% over 10 years. You're rolling in $758,000 at the end of the 10 years. Well, is that possible? Well, it's just a ballpark. That's a target that you might want to shoot for. But I think that is an awesome, awesome return. So let's take a look at this another way. Let's say the Jane and Bob Smith, they created a note for $100,000, and not the mobile home that I was talking about earlier, but a stick-built house, $100,000, and that borrower has paid down and it's nicely seasoned, and now they owe $85,562.87. Let's say they've got 25 years remaining. Well, Bob and Jane now want to go take that money out and go do something else with it, and they want to unlock that. And this is where they come to you and say, I want to sell this for $85,562, but like the lottery, you're like, no, I don't really want to do that. But you don't want to let the deal go, right? Because you've got this great note here. Well, okay, this is what you do then. You offer to buy half of the unpaid balance of the note for half the remaining payments. And then you tell them after receiving those payments, you will buy the second half of the note at that time. So this way they get really close to their money. They're not discounting anything. Their present value then is half of that $86K and change. That means that the present value you'd be buying from would be $42,781.43. That means you'd be getting, 15.98%, and the payment is $660.39. Well, that's not bad. That's almost 16%, right? It used to be 8%, now it's almost 16. So this is called split funding. This is when you buy half of the remaining payments for half of the note balance. This is always going to double the face interest of the yield, which is kind of a cool thing to remember on the notes that you're dealing with or that you want to buy from somebody. So let's take a look at another technique, and this is the 10 for 12 technique. This works pretty good on small amounts that you're going to pick up. When the number of payments is small, then you ask for a slight discount, and then it gives you a crazy high yield. So let's say Jane and Bob, they just need $10,000 to pay for their daughter's wedding, or they want to go on the big cruise. They've got $100,000 note, and it's paying, let's say, $1,000 a month. We'll just use these round numbers. So you offer to pay them $10,000 for the right to receive the next 12 payments. So you're getting the 10 for 12, right? So what does that look like? The monthly yield on any 10 for 12 deal is always 35.0%, which is awesome. I love this deal, especially for little tiny deals that you can just walk into. And especially when you've got a self-directed IRA, you may have a lot of notes, or you've got other performing properties, and maybe those are big ticket items. But your IRA is going to accumulate cash over time. Maybe the odd 10 or 20,000 is sitting there, and you want to put it to work. So this is a good way of doing that. So let's take a look at another case study. And I'm using a house that actually it's a note, and we just put this note for sale, by the way. If you're looking for a note to buy, please reach out to me, because I'll send you the info on this one. But I'm going to use these as numbers that are similar to what this deal is all about. So let's say you buy a house for $20,000 cash. Could be in your IRA, just cash out of your pocket. You sell it for $40,000, and you get $8,000 down. You create a $32,000 note for 60 months on payments of $664.57. So this is a cash in deal and paper out deal, right? That means if, as an investor, a note investor, if you want to create your own notes, you go buy a property for cash. They're out there. It depends on the market, and it maybe won't be in your market, but there's still plenty of out there. So this one is in Kansas City. Just to give you a hint, you'll find plenty of them in the Midwest. So what if you don't have $20,000? Bummer. Well, you can solve that problem. Let's see how. You go partner with an investor or find an investor to fund you the $20,000. When that borrower comes and pays the $8,000 or $8,000 down, and they get to keep that payment, they will be getting a 22.12%. So here's the monthly payment in half, right? It's $332. Let me go back and show you that. So the monthly payment was $664.57. It's a short-term note, could be an investor buying a turnkey rental kind of a situation, $664. Now you're paying your investor $332.28. Their total investment now, minus the $8,000 down, is $12,000. They get an awesome 22.12%. You get an even better deal. You get infinity because you got nothing in the deal. You're getting $332 over 60 months and you have not put a penny in it. That is really the way to do it if you can. Now, not all of them are going to be home runs like that, but I just wanted to show you what's possible when you do work with investors. I always like to have everybody walk away happy on this deal. I would happily step in as the investor on this deal, and you can go ahead and get infinity from me if I'm getting 22%, right? I mean, call me if you've got that. Or if you want to work with me and do this deal, I will get you those deals. So that's kind of an overview of some of the things that you can do with notes. I think that they provide better and greater strategies than just buying and leveraging a rental. I know a lot of investors will do that, and that's cool. That's great. But I really like this way of doing things. I want to give a shout out to Tom Henderson, the note professor. I use a lot of his examples here in this presentation. And so if you are interested in finding out about some of the things, he really has great ideas. You really have to go look at him. You can find him at hpnotes.com. He's been in the business a long time, and he's worth checking out. So anyway, thanks very much for listening. Next month, I'm going to do another Phoenix meetup here, and I will record that as well to put that out there to you guys that are out far and wide. Thanks again for joining.